If you're 65 or older, there's a brand new deduction this year worth up to $6,000, and it's on top of every other senior tax break you already get. It's called the Enhanced Deduction for seniors, and it was created under the One Big Beautiful Bill Act signed in July 2025. But many seniors are missing it entirely, either because they don't know it exists or because they're confusing it with the additional standard deduction they've been claiming for years. These are two separate benefits, and you can claim both. This deduction applies to the 2025 through 2028 tax years. If you turned 65 before January 2, 2026, you qualify for the current filing season. A single senior with income under $75,000 gets the full $6,000 deduction. A married couple filing jointly where both spouses qualify can deduct up to $12,000. Here's what makes this unusual. It stacks. A single senior taking the standard deduction can now shield up to $23,750 from federal income tax. That's the $15,750 standard deduction, plus the $2,000 additional standard deduction for being 65 or older, plus the new $6,000 enhanced deduction. For a qualifying married couple, the combined total is $46,700. Three things must be true to qualify. First, you must have been born before January 2, 1961. That means you turned 65 by the end of tax year 2025. If you turn 65 during 2026, you'll qualify when you file next year, but not for this filing season. Second, you need a valid Social Security number. An ITIN does not qualify. If you're married filing jointly and both spouses want to claim the deduction, both must have valid Social Security numbers. Third, if you're married, you must file jointly. Married filing separately gets a $0 deduction, the same rule that applies to the tips and overtime deductions we covered earlier in this series. The deduction is available whether you take the standard deduction or itemize. You don't have to choose. It works alongside both. You'll claim this deduction on Schedule 1A, Part 5, attached to your Form 1040 or 1040 SR. Start with your base amount, $6,000 per qualifying person. If both you and your spouse qualify, that's $12,000. Next, check your modified adjusted gross income. Pull this from Form 1040, line 11B. For most retirees, your MAGI equals your adjusted gross income, unless you have foreign earned income or certain exclusions. If your MAGI is under $75,000 for single filers or $150,000 for joint filers, you get the full deduction. No math required. Just enter $6,000 on Schedule 1A and move on. If your MAGI exceeds the threshold, the deduction shrinks. The reduction is 6% of every dollar above the threshold. In practical terms, for every extra $1,000 of income above the limit, you lose $60 of your deduction. A single filer earning $100,000 is $25,000 over the threshold. 6% of $25,000 is $1,500, so the deduction drops from $6,000 to $4,500. The deduction disappears completely at $175,000 for single filers or $250,000 for joint filers. Your final number transfers to Form 1040, line 13B, the same line where tips, overtime, and car loan deductions land. They all add up together. This deduction covers tax years 2025 through 2028. Unless Congress extends it, it expires after that. There is no fee to claim it. Your filing deadline is April 15, 2026. The IRS has already flagged the new senior deduction as a common error area this season. Here are the mistakes to avoid. First, confusing the enhanced deduction with the additional standard deduction. They are two different benefits. The additional standard deduction for seniors, $2,000 for single filers, $1,600 per spouse for joint filers, has existed for years. The new $6,000 enhanced deduction is a separate additional benefit on top of that. You claim both. Second, thinking you need to itemize. You don't. The enhanced deduction works whether you take the standard deduction or itemize. Many seniors assume it's one or the other. It's not. Third, filing married filing separately. If you file MFS, your enhanced senior deduction is $0, even if you're over 65 and otherwise qualify. This is the same restriction that applies to the tips and overtime deductions. Fourth, missing the age cutoff. You must have turned 65 by December 31st of the tax year you're filing for. If you turned 65 in 2026, you can claim the deduction when you file in 2027, not this year. Fifth, not accounting for all income sources. Social Security benefits, pension distributions, required minimum distributions, and investment income all count towards your MAGI. Many retirees underestimate their MAGI because they think Social Security doesn't count, but the taxable portion does. Sixth, assuming your state honors this deduction. Some states like California and Arizona haven't conformed to the new law yet. If your state uses a fixed date conformity to the federal tax code, you may owe state tax on income that's now exempt at the federal level. Check your state's rules before counting on a state-level benefit. If you're 65 or older and your income is under the phase-out threshold, this deduction is straightforward. Enter $6,000 on Schedule 1A, Part 5, and you're done. Even if your income is above the threshold, you may still qualify for a partial deduction up to $175,000 single or $250,000 joint. This is the final video in our 4-part 2026 Tax Changes series. If you missed the earlier videos on tips and overtime, those links are in the description. Each one covers a deduction you can stack with this one on the same Schedule 1A. Our free guide has a complete breakdown of the stacking math, a worksheet to calculate your exact deduction, and a chart showing how the phase-out affects your benefit at every income level. Download it using the link in the description.
Thank you for watching GovClarity. Remember, you can find our complete guide and all official links in the More section. If you found this helpful, please like, subscribe, and share it with others who might benefit. Remember to hit the notification bell so you never miss our latest videos. We're here to make government procedures easier for you every step of the way.